The impact of inflation is felt in many aspects of our lives, and retirement is no exception. Even with small percentage changes in inflation, your odds of a successful retirement can change drastically.
Let's say, hypothetically, we have a client wanting a tiered retirement goal of $7,500 a month for the first 10 years, $6,500 a month for the next 10 years, and then $5,500 a month for the rest of their life. Let's also assume they have $650,000 in assets and are currently saving $2,000 a month.
You can see that this goal is actually achievable with a pretty good degree of confidence. This is with an inflation of 2.2%, which is close to the long-term average inflation and the Federal Reserve target rate of 2%. In this hyperinflationary time we live in now, we wanted to show the client the impact of a higher inflation amount for a longer period of time. Increasing inflation to 3.2%, which is close to what we see now, takes the probability of success from the mid to high confidence zone of 85% to the low end of the confidence zone at 72%. Just a 1% change in the inflation rate has dropped the odds of a successful retirement by 13%. So why is this? Let's look deeper into the various ways inflation impacts retirement. Diminished purchasing power. Inflation gradually erodes the value of money, reducing its purchasing power over time. What this means for retirees is that the same amount of money will buy fewer goods and services in the future compared to the present. As retirees transition from the workforce to a fixed income lifestyle, they become increasingly vulnerable to the effects of inflation. Their retirement savings, carefully accumulated over years of hard work, may lose value in real terms, making it challenging to afford the same standard of living in retirement that they enjoyed during their working years. Erosion of fixed incomes. Many retirees rely on fixed income sources such as pensions, annuities, and Social Security benefits to cover their living expenses in retirement. However, these income streams may not keep pace with inflation if they lack cost of living adjustments or COLAs. Without adjustments to account for rising prices, the purchasing power of fixed incomes diminishes over time, putting retirees at risk of financial strain. Even modest levels of inflation can significantly erode the real value of fixed incomes over the course of a retirement that may span decades. Increased cost of living. The rising cost of living due to inflation can place additional strain on retirees' budgets. Essential expenses such as housing, healthcare, food, and utilities tend to increase in price over time, consuming a larger portion of retirees' fixed incomes. Healthcare costs in particular have been outpacing general inflation, posing a significant financial burden for retirees, especially as they age and require more medical care. Retirees may find themselves forced to make difficult choices, such as cutting back on discretionary spending or dipping into savings to cover rising expenses. So what can we do about that? The biggest key to mitigating inflation risk is financial planning. In this case, we may have to plan for a lower retirement spending amount or retiring a little later. We also need to make sure that accurate inflation is accounted for in your goals. For example, in the financial plans we run, we separate goals such as healthcare and college expenses. We do this because those two categories typically inflate at higher levels than normal living expenses. Having a comprehensive financial plan is one of the most important ways that you can mitigate the impact of inflation on your retirement goals. If you have any more questions or would like a financial plan for you and your family, you can email us at education@thenoblegroup.com, give us a call, or visit our website at thenoblegroup.com.